It's Monday, 3rd of August, 2026. Welcome back to your news update on Blit Brief, crisp, but almost everything updated every market trading day. So if you blink this weekend, you completely missed a geopolitical pivot that basically just erased the fear premium in global oil.
Right. I mean, U.S. President Trump abruptly pulled the plug on those planned military strikes against Iran.
Yeah, he's betting heavily on a rapid diplomatic deal, to curb Tehran's nuclear ambitions, and crucially for global trade to make sure the Strait of Hormuz stays wide open.
And this wasn't just some sudden burst of goodwill in Washington. This was hard-nosed economic lobbying from Riyadh and other Gulf capitals. The back-channel maneuvering here is, it's actually really fascinating.
Because they directly counseled the U.S. administration against kinetic action, right?
Exactly. Gulf leaders understand the catastrophic economic fallout a full-scale regional war would trigger. I mean, specifically, the immediate disruption of their own energy exports. So they aggressively advocated for diplomatic leverage instead.
Which makes sense. And the market reaction was completely instantaneous. Because the threat of an immediate supply disruption in the Gulf just vanished overnight, the fear premium evaporated.
Oh, absolutely. We saw crude oil prices crash instantly. They plunged anywhere between 5% and 7%.
Right. When the risk of the strait being blocked diminishes, the market recalibrates at lightning speed.
Yeah.
But wait, looking at India's energy strategy, I have to push back on our positioning here.
Go ahead.
Are we just crossing our fingers and hoping the Strait of Hormuz stays open? I mean, are we actively pivoting our supply chains to insulate ourselves from this volatility, or are we still entirely at the mercy of these Gulf headlines?
Well, it is the most logical question you could ask, especially if you're watching your own transport costs. But the reality of India's petroleum infrastructure tells a vastly different story.
How so?
Despite this regional conflict and all the wild price swings we have seen, Indian Oil has explicitly ruled out shifting its crude sourcing away from the Gulf.
Wait, really? That sounds incredibly risky to me. Why stay so heavily exposed to a geopolitical powder keg?
It basically comes down to the underlying chemistry and the massive capital sunk into our infrastructure. Indian refineries, particularly the coastal mega refineries, are structurally optimized for these specific, heavy, high-sulfur grades of crude that come out of the Middle East.
Oh, so retooling them would be a nightmare.
Exactly. Retooling complex refineries to process light, sweet crude from entirely different geographical hemispheres involves astronomical capital expenditures and logistical nightmares, frankly.
Right.
The Gulf just remains the most efficient, cost-effective supplier for us. And what is truly surprising is the financial resilience of our domestic players right now.
Yeah, the financial hit to Indian oil marketing companies in the first quarter was actually a fraction of what the government initially feared. Their losses came in at nearly 75% below the initial loss forecast.
Which is massive. So they absorbed the shock far better than the street models predicted. They likely managed this through, aggressive inventory management, better refining margins on exported products, and leveraging strategic petroleum reserves.
It tells you a lot about the maturity of our oil sector, honestly. And how is this translating at the pump for you, the consumer? Because the domestic macro picture is showing some serious acceleration. Let's look at road fuel demand.
Right, the numbers are strong.
Petrol sales jumped nearly 10%, and diesel rose over 10% in July.
The why behind those fuel numbers gives you a real-time pulse of the Indian heartland. That surge, particularly in diesel, is heavily driven by a delayed monsoon.
Because of agricultural backup generators.
Yes, exactly. When the rains are delayed, the massive agricultural sector is forced to rely on diesel-powered backup generators for irrigation just to save the season's crops.
Right. Combine that agricultural demand with strong passenger and commercial vehicle sales across the board, and you get that double-digit spike in road fuel demand. Conversely, though, we saw LPG consumption plunge over 17%.
Which points to aggressive inventory destocking by distributors and slight shifts in domestic consumption patterns during the warmer, drier months.
Interesting. Now, if you are tracking consumer behavior, here is where the data gets genuinely fascinating. While traditional fuel demand is up, the electric vehicle sector is absolutely exploding.
Oh, shifting into top gear, definitely.
Driven by the panic of high fuel prices stemming from those U.S.-Iran war fears over the last few months, EV sales grew nearly 100% in July compared to last year, literally doubling.
It is a perfect example of how macro geopolitics directly alters micro-consumer behavior at your local dealership. Consumers basically hit a psychological tipping point.
How do you mean?
Well, when they modeled out the total cost of ownership, the equation flipped. With the fear of double-digit percentage spikes in petrol prices hanging over their heads, EVs were no longer just a luxury or an environmental statement.
Right, they became a rational financial hedge.
Exactly, an urgent hedge against the pump price. The payback period for the higher upfront cost of an EV shrunk dramatically in the minds of the buyers.
Makes total sense. And stepping back to look at the broader economy, the macro indicators you need to track are remaining highly robust. Like July GST collections rose over 15%.
Which is a clear, unmanipulated signal of strong underlying consumption and transaction velocity across the country.
Yeah. Furthermore, India just climbed 25 places in the global competitiveness ranking.
That 25-place jump is a massive structural win, frankly. It is directly attributed to regulatory reforms that have successfully reduced market distortions, dismantled archaic compliance burdens, and just made it easier for institutional capital to operate.
But hold on, I have to stop you there. If domestic demand is so hot, and if our GST collections are surging by over 15%, we are 25 places more competitive globally, there was a glaring contradiction in the capital flow data.
You're talking about the FDI drop.
Yeah. Why has Chinese foreign direct investment into India crashed by almost 100% in the last financial year, dropping to near absolute zero? If we are so competitive, why did that money just vanish?
Well, it is a stark drop, I admit. But you have to firmly separate the domestic regulatory environment from the economic appeal of the market. The crash in Chinese FDI is absolutely not due to a lack of market appeal.
So it's not about consumer demand or poor return on equity.
Not at all. It is entirely the result of tighter regulatory scrutiny and strategic vetting by New Delhi. The capital gates have been intentionally narrowed for specific geographies, due to broader geopolitical calculations and national security directives.
Oh, I see. So the institutional money is still coming in. It is just arriving from different zip codes and flowing into very different verticals.
Exactly right. Capital is highly fluid, and it abhors a vacuum. It is flowing from Western and Middle Eastern sovereign wealth funds, and more importantly, it is flowing into the infrastructure of the future.
Like what? Give me an example.
Look at data centers. They captured a massive 40% of all institutional capital in the first quarter.
Wow, 40%.
Yeah. Investors are aggressively pouring money into the digital real estate required to power the AI and cloud computing boom. Data localization laws mean that data generated in India must be stored in India.
Which makes these server farms one of the highest yielding real asset classes available right now.
Precisely. Meanwhile, on the monetary policy front, a recent poll of economists suggests the RBI's Monetary Policy Committee will likely maintain a neutral stance.
Right. They're widely expected to keep interest rates unchanged for the fourth consecutive time. The central bank's priority right now is ensuring growth stability while keeping a highly watchful eye on global currency volatility.
Which is a delicate balancing act for sure.
It is, and it's fascinating that while the RBI is focused on keeping the macro environment stable, the broader stock market is acting as a brutal proving ground for individual companies.
Oh, absolutely.
Let's look at how this is reflecting in the stock markets and corporate boardrooms. Keep in mind, the numbers we are discussing are the previous trading day's closing figures, as today's markets have yet to open. The broader market showed resilience, with the BSE Sensex closing up over 0.2% and the Nifty 50 up nearly 0.3%.
Yeah, the headline indices look calm on the surface, but the real story, as is often the case, is hidden in the broader market breadth. The mid and small cap spaces saw explosive, highly concentrated moves.
Absolutely. If you were holding specific equities in the small and mid-cap space, you saw massive wealth creation. I mean, Transpec Industry and Yasho Industries both skyrocketed exactly 20%.
And ESAF small finance banks surged over 16%. These companies likely delivered exceptional forward guidance or announced major capacity expansions that the street just immediately rewarded.
Right, but it certainly wasn't all green on the screen. Looking at the losers, Explio Solutions dropped nearly 12%, Thangamail Jewelry fell 10%, and Signpost India dropped over 9%.
Those stark divergences really highlight that this is very much a ruthless stock pickers market right now. You cannot just buy the index and expect uniform returns.
Not at all.
Take Explio Solutions, for example. A double-digit percentage drop usually points to severe margin compression in their tech services, or maybe delayed client spending in their European markets.
And for Thangamail Jewelry, falling 10% suggests that sustained high gold prices are actively denting retail volume in rural markets, right?
Yeah.
Squeezing their operating margins.
Exactly. And Signpost India dropping over 9% typically indicates municipal regulatory clampdowns on their digital out-of-home advertising billboards. That instantly threatens their revenue run rate.
So investors are rewarding specific corporate earnings visibility while ruthlessly punishing any misses, margin erosion, or governance concerns.
It's a highly unforgiving environment.
Speaking of global cross-currents impacting your portfolio, let's talk about currencies and commodities. Following strategic interventions by their central bank, the Japanese yen leapt significantly, which ended up severely bruising the US dollar.
Yeah, that was a major move.
And in precious metals, gold slipped over 0.3%, while silver dropped nearly 1%.
Yeah.
If you were holding silver this year, you have felt the pain of a brutal run. I mean, it is down over 20% year to date.
Silver is a fascinating asset right now, honestly, because it suffers from a dual identity.
How so?
Well, it is heavily traded as both a precious metal and a highly utilized industrial commodity. Its massive 20% drop this year is heavily pressured by the strong U.S. dollar and the U.S. Fed's sustained restrictive policies.
Right. The mechanics there are pretty straightforward. When the dollar is strong, dollar-denominated assets like silver become significantly more expensive for buyers holding other currencies.
Which instantly suppresses global physical demand. Furthermore, high interest rates make non-yielding assets like precious metals fundamentally less attractive to institutional managers compared to risk-free treasury bonds.
Makes total sense. Now let's pivot from macroeconomic pressures to a massive regulatory cleanup happening right here at home. SEBI has brought down the hammer.
They certainly have. They have officially barred ZEL promoters, Subhash Chandra and Puneet Goenka, from the markets for a year. That throws a massive dark cloud of uncertainty over their heavily publicized plans to hike their stake in the company.
This is an incredibly strong signal from the regulator regarding corporate governance. I mean, when key promoters are barred from accessing the capital markets, it completely restricts their ability to raise debt, pledge shares, or alter their holding structures.
Right, they're frozen out.
Exactly. This regulatory roadblock can completely derail the strategic roadmaps for the company, making institutional investors highly nervous about the leadership vacuum.
And SEBI wasn't done cleaning house. The National Stock Exchange finally paid a massive settlement to SEBI regarding the long-standing co-location case.
A vital reminder of the days when certain algorithmic brokers were allegedly getting a split-second head start on the exchange's data feeds.
Absolutely. But I want to focus on something that directly affects every trader listening right now. We have new critical market mechanics taking effect today.
The closing auction.
Yes. If you trade derivatives, your 3.15 p.m. routine is about to drastically change. How exactly will the new closing auction overhaul the traditional rush that traders are so used to?
Well, it is a major structural overhaul specifically designed to protect the integrity of the closing price. Previously, the final minutes of continuous trading could be highly chaotic and easily manipulated by massive last-second orders.
Right. So what happens starting today?
Starting today, continuous trading for futures and option stocks will end promptly at 3:1 p.m. At that exact moment, the system moves into a dedicated call auction process to determine the final closing price, while the derivatives themselves will continue to trade normally until 3:4 p.m.
So break that down for us a bit. What does shifting from continuous trading to a call option actually mean for true price discovery?
It fundamentally curbs extreme split-second volatility. In a continuous market, a sudden massive market sell order at, say, 3:29 p.m. can artificially skew the closing price of a stock.
And why does that matter so much?
Because the valuation of massive institutional portfolios and the net asset value, or NAV, of mutual funds are calculated based on that exact closing price. If it is manipulated, millions of retail investors suffer the tracking error.
Oh, wow. I see.
Yeah. So by moving to a call option system at 3:15 p.m., the exchange stops continuous matching. Instead, it collects all buy and sell orders over a specific window, aggregates them into an order book, and calculates a single equilibrium price.
A price where the absolute maximum volume of shares can be traded.
Exactly. It is a much cleaner, highly democratic way to find the true fair value of a stock at the closing bell, immunizing it against last-second institutional spoofing.
So we are deploying better algorithms to curb market volatility and improve precision. That concept is actually the perfect conceptual bridge to our final segment today, which features a massive technological and defense breakthrough from the DRDO.
This is a big one.
India is officially stepping into the future of warfare. The DRDO has successfully tested a new laser weapon system, marking a monumental leap into directed energy weapons, or DWs.
This is a complete paradigm shift in how we must think about national defense and military budgets.
Really?
Yeah, the historical reliance on traditional ballistics, missiles, intercepting missiles, is slowly being phased out for high-tech, energy-based solutions that operate on entirely different physics.
So if I'm understanding the mechanics of this right, traditional interceptors are basically throwing million-dollar rocks to hit cheap incoming rocks.
That's one way to put it.
I mean, you have to calculate the trajectory, wind speed, and basically hope your expensive rock intercepts their cheap drone. A laser weapon changes the math entirely.
Completely.
We are trading a limited magazine of expensive explosives for a high-powered flashlight that only costs whatever the diesel generator burns to create the electricity.
Exactly. You have hit on the fundamental economic and tactical shift here. A directed energy weapon fundamentally alters the asymmetry of modern warfare. Right now, a swarm of cheap commercial drones can overwhelm a sophisticated radar and missile defense system simply by depleting its physical ammunition.
Because your magazine goes empty and the defense fails.
Precisely. Instead of a physical projectile, a laser system uses highly concentrated electromagnetic energy. It travels at the literal speed of light.
Meaning the target doesn't even know it's being hit until it begins to melt, because a beam outpaces any warning system.
Exactly. No radar warning receiver can detect an incoming light beam in time to initiate evasive maneuvers. It makes it virtually impossible for a target to evade once the system has locked on.
That's incredible.
And it offers incredible pinpoint precision, which minimizes collateral damage. But tactically, its greatest advantage is that it theoretically has an infinite magazine.
Right, as long as you have a diesel generator or a stable power grid hooked up to it, you can just keep firing continuously.
Right.
So the cost per shot literally goes from millions in currency for a kinetic interceptor to just the cost of a few liters of diesel to generate the necessary kilowatts.
That is the crucial economic victory. It is a highly cost-effective technology that can blind, disable, or completely destroy incoming threats so quickly and efficiently that it might end future localized conflicts before they even have a chance to escalate.
It completely neutralizes the asymmetrical financial advantage that cheap drone swarms currently hold over our expensive traditional defense network.
It absolutely does.
If AI and algorithms are currently optimizing our closing auction prices to prevent chaos and remove human manipulation, how long until a directed energy weapon's infinite magazine is completely managed by predictive AI?
That's the logical next step.
We could soon see a reality where algorithms are detecting threats, calculating the energy output, and firing light-speed weapons autonomously, removing human decision-making from battlefield defense entirely. Just something to think about next time you look at defense and technology stocks. And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.